Going over silver futures. In this video, we'll be going over my trade idea of the week and the day-by-day probability model. So let's start off with the technical analysis on the 1 hour chart. We still remain in positive MACD. We did see a diverge and we're approaching to negative MACD territory, but we're still resting right along the 18 moving average, this purple line, currently at the price of $27, and we're off of overbought levels with the RSI. As we extend that to the 4 hour chart, we remain in positive MACD and slightly off of overbought condition. As we extend that once more onto the daily chart, we still remain in positive MACD. We did see it converge, and as for support, that'll be where you have the 150-day moving average, this red line, which acted as support in the past, as indicated with January 19th, is currently at the price of $24.52. And for resistance, our first immediate one will be where you have the highs, will be at January 6th at the price of $28.08. If we were to test that resistance level, that price movement to the upside is roughly around 3.9%, and to test support, that is around 9.3% to the downside. As for the trade idea of the week, I'll be trading SLV, and my position size for it is less than 1% of my portfolio. My long entry is at $23.56. My sell target for it is at $25.42, and my stop loss is at $23.16. However, if I were to open a short position, my entry is at $26.42, and my sell target for it is at $23.99, and my stop loss is at $26.87. So whichever entry price were to hit first, that will be my position of the week. So how did I develop these trade ideas? It all comes from the day-by-day probability model, which is available in the link below, so do check it out. As we progress to the 5th day or week of trading, we have a 30% chance for silver to climb between 0 to 5.7%, a 60% chance to fall between 0 to negative 5.7%, and a 10% chance to fall between negative 11 to negative 18%. So if you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.